Globally, gold is used to determine the value of currencies. Gold's price is often expressed in currency terms, often in the US dollars, and it can fluctuate according to market conditions. In the current market, what influences gold's price? Well, let's dive in and find out what influences the price of gold. Number one, the value of the US dollar. Now, the US dollar remains the world's dominant reserve currency, making them one of the main currencies that countries hold for international trade. There is a clear inverse relationship between gold's price and the strength of the dollar. When the dollar is strong, gold is weaker, and vice versa. Number two, central bank instability. The Federal Reserve is the central bank of the United States. Now, there are central banks in most countries, including the European Central Bank, the Bank of Japan, and the Swiss National Bank. In times of bank failures and irregular economic policies, gold appears to be a safe haven investment. The current paper money system experiences uncertainty once again, causing people to flock to gold. When the central banks are experiencing deficits, some investors prefer gold as a means of protecting their wealth. Due to increased demand, gold's value increases even further. Number three, interest rates. Unlike treasury bonds and savings account, gold does not pay interest, but current gold prices often reflect changes in interest rates. The price of gold may soften as interest rates rise, allowing people to invest in other investment options. As interest rates decrease, gold prices may rise again since gold has a lower opportunity cost than other investments. There is a greater attraction to gold when interest rates are low. Number four, quantitative easing. Quantitative easing, or QE, is a strategy by which central banks buy securities to increase the money supply. A central bank, such as the Federal Reserve, hopes to increase the supply of money by flooding financial institutions with money. Among other central banks that have used this strategy are the Bank of England, the Bank of Japan, and the European Central Bank. Because of a lower opportunity cost, a larger money supply lowers interest rates, which encourages investors to buy gold. Overdoing this tactic can trigger inflation, another sign that gold prices are rising. Number five, inflation. Gold is often held as a hedge against inflation and currency devaluation. While currencies' value fluctuate, gold values in terms of what an ounce of gold can buy might remain more stable over time. The fact that gold holds value outside of politics makes gold a low-risk, solid investment in the midst of floundering currencies. As paper's money value declines, investors may feel compelled to buy gold. Number six, global crisis. Often called a crisis commodity, gold prices rise when people lack confidence in government or financial markets. Due to its role as a source of safety during economic and geopolitical turmoil, world events often affect gold prices. During the Russian invasion of Ukraine, the price of gold spiked as people became uncertain about geopolitical stability. Number seven, supply versus demand. Gold has been mined and coveted for at least 5,000 years, and it is likely that the precious metal will remain valuable even if its prices fluctuate often. You should understand that gold prices are affected by production cost, money supply, comfort or discomfort with financial or geopolitical stability, jewelry and industry demand, and central bank action. The price of gold rises when global economic conditions make gold more attractive, making it a finite resource. In the long run, gold's value remains relatively stable, so prices fluctuate may simply reflect temporary uncertainty or currency's fluctuations.